Welcome to Breaking News to Trading Moves. Today we're looking closely at a significant financial development: potential new U.S. tariffs on goods coming out of Vietnam. The numbers involved are pretty substantial. The UN suggests Vietnam could face losses around $25 billion, which naturally puts pressure on supply chains.
Yeah, that $25 billion figure isn't just abstract, is it? It really means immediate cost increases for some companies and, well, sudden advantages for others. It often comes down to decisions made years ago about where to set up manufacturing. So our goal for you today is pretty straightforward. We want to cut through the broader trade talk and pinpoint which companies look better positioned because of their supply chains.
And also which ones might face some immediate financial challenges.
Exactly.
Yeah.
Which major players could see their margins squeezed this year. We want you to get a clear sense of the impact across different sectors, from shoes to shipping.
Okay, let's start with the potential winners then. It's always interesting when a policy change like this creates, well, almost accidental beneficiaries. If import duties rise for one country, who stands to gain because they set up shop elsewhere?
Right. Well, a good place to start is with apparel basics. We can maybe call them the defenders in this situation. Take Gildan Activewear, GIL, for instance. The really critical thing for them is that they're vertically integrated.
Vertically integrated? I mean, they control the whole process.
Pretty much, yeah. From spinning the yarn right through to the finished T-shirt or sweatshirt, they own most of that supply chain.
And crucially, where are their factories? Not Vietnam, I gather.
Exactly. Their main manufacturing hubs are heavily concentrated in Central America, the Caribbean, and also Bangladesh. So they have very little, almost zero, direct exposure to Vietnam. Now, you're making millions of basic items, avoiding a sudden, say, 20% tariff on your landed cost. Well, that's a huge structural plus.
Okay, avoiding the tariff makes sense. But does that relative price advantage really stick? I mean, weren't places like Central America sometimes seen as having slightly higher costs historically compared to maybe third-party factories in Southeast Asia?
That's a fair point, but a potential 20% tariff changes the math completely, especially in the world of high-volume, low-margin basics sold wholesale. That lack of tariff pressure gives Gildan an immediate, pretty clear boost for their margins and their ability to gain market share. They don't have to absorb that cost, and they don't need to raise prices like competitors who are suddenly dealing with these new duties on similar Vietnamese goods.
That flexibility sounds really key. What about Hanesbrands, HBI? Their model's a bit different, but they seem similarly protected.
Hanesbrands is another really good example of how diversification and owning production helps. They have a lot of their own manufacturing facilities in places like the Caribbean and Central America, and they benefit from agreements like CAFTA-DR.
Right. CAFTA-DR, that's the Dominican Republic Central America Free Trade Agreement, gives them better access to the U.S. market, correct?
Precisely. That agreement, plus having their own production in other parts of Asia outside Vietnam, gives Hanesbrands a lot of flexibility. They can shift orders around without hitting that potential 20% cost increase. Meanwhile, competitors who rely heavily on Vietnamese suppliers for things like underwear or activewear might have to either eat the costs, which hurts profits, or pass them on as higher prices in the U.S. Either way, it improves Hanesbrands' competitive spot, relatively speaking.
Makes sense. Now, moving away from apparel for a moment, these tariffs could also speed up the trend of nearshoring, right? Bringing production closer to home.
Absolutely. That conversation is definitely getting louder. If U.S. companies decide to shift production out of Southeast Asia and into, say, Mexico to avoid these Vietnam issues, that's nearshoring. And that directly fuels demand for cross-border logistics.
Which brings us to companies like Canadian Pacific Kansas City.
Yeah, exactly. CPKC runs that huge rail network connecting Canada, the U.S., and Mexico north-south. They're really well-positioned to handle that increased freight traffic.
So more goods moving between Mexico and the U.S. means more business for them.
Precisely. We could see higher cross-border rail volumes. And it's driven by two things. One, just the general desire to diversify supply chains away from Asia, and two, the specific need to avoid potential Vietnamese duties and the extra scrutiny around transshipment.
Transshipment, can you just quickly explain that?
Sure. It's basically trying to disguise where goods originally came from. So you might illegally route goods through a third country to pretend they originated there and avoid tariffs meant for the actual country of origin, like Vietnam in this case. When the U.S. applies tariffs, they also ramp up checks to make sure goods labeled made in country X actually were made there. Nearshoring to Mexico just avoids that whole legal complexity.
Got it. That definitely adds value to having regional capacity ready to go. Are there any smaller companies benefiting from this nearshoring angle?
Yeah, you shouldn't overlook some of the smaller regional players. Delta Apparel, DLA is one. They operate a very quick-turn supply chain, mostly in the Americas. These tariffs suddenly make their regional model look even more attractive for basics and private label programs. Why? Because the cost of being able to react quickly without long lead times or tariff worries has just gone up for their rivals relying on Asia.
Interesting. Okay, before we switch to the companies facing more pressure, there's one big outlier we should mention, Apple, AAPL. They do use Vietnam for some manufacturing, but they seem less affected than the apparel companies. Why is that?
Right, this is a really important distinction based on what kind of products we're talking about. Generally, consumer electronics currently have exemptions from these specific tariffs that footwear and clothing don't. So while Apple does have assembly operations in Vietnam, it's mostly for things like audio accessories. And that type of assembly work isn't currently targeted by the specific duties hitting other consumer goods sectors right now.
So their exposure is relatively small and, for now, exempt.
That's the situation currently, yes. This relative insulation helps protect Apple's supply chain stability and their demand outlook, especially when you compare them to footwear and apparel firms facing almost guaranteed margin pressure from potentially much higher landed costs overnight.
Okay, that makes sense. Let's pivot now to the other side of this. We've talked about who might gain. Now let's look at the companies that could face immediate difficulties because they rely heavily on Vietnam as a manufacturing base. This is where that $25 billion UN estimate really starts to bite, doesn't it?
Absolutely, and the sector that looks most exposed, arguably, is athletic footwear. Over the last decade, there was a big shift in production to Vietnam, partly to move away from China. Nike is probably the most prominent example here. Vietnam is just a massive, crucial hub for their footwear production. A huge percentage comes from there.
And what does that translate to financially? What's the direct impact?
Well, the math is pretty stark, unfortunately. A potential 20% duty on goods from Vietnam directly increases their landed cost. That's the total cost to get the product to the U.S., including shipping and duties. If duties jump 20% on, say, a third or more of your incoming goods cost, that puts serious pressure on your gross margins. For a company like Nike, usually operating with gross margins in the mid-40% range, absorbing a hit like that is, well, it's significant. It really pressures profitability unless they take action.
And their actions are limited, aren't they? They
Right.
basically have to either swallow the cost, hitting their profit margins,
Sure.
or they try to pass it on to consumers through higher prices.
That's the dilemma. If they raise prices too much, they risk hurting demand, especially if consumers are already feeling pinched by inflation. People might just buy fewer shoes or switch brands, but if they absorb the cost, Wall Street might punish them for lower margins. And importantly, their main competitors are largely in the same boat.
You mean like Adidas, ADDYY, and Puma,
Yeah.
PUM,
Exactly. Adidas relies heavily on third-party manufacturers in Vietnam, too, for both shoes and apparel. This tariff situation really complicates their pricing strategy in the U.S. and how they manage inventory. There's a risk they end up with too much stock ordered at the potentially higher tariff-inclusive price, especially if retailers push back against accepting those price increases fully. Retailers might demand more promotions to clear inventory.
Which hurts margins anyway, and Puma is facing similar issues.
It's largely the same story for Puma, given their reliance on Vietnam for athletic footwear. These U.S. tariffs could squeeze their gross margin or force them to raise list prices, which could then slow down how quickly their products sell through at major retailers. It really highlights the risk when companies, maybe seeking efficiency years ago, became heavily concentrated in one production region.
And this pressure isn't just limited to sneakers, is it? Major clothing brands are also affected. What about VF Corp, VFC? They own brands like Vans, The North Face.
VF Corp does source from various places, but Vietnam is still a meaningful part of their mix. So for them, the impact is likely higher import costs. Or they face the complexity and expense of trying to reroute production or finished goods through other Asian countries, which isn't always easy or quick. This weighs on gross margin, sure, but it also affects their speed to shelf. Getting new products, especially seasonal ones like winter coats or specific shoe styles, into stores on time is critical. Delays can be almost as damaging financially as the tariff cost itself.
Right, missing a key selling window is bad news. And finally, what about PVH? Owner of Calvin Klein, Tommy Hilfiger.
PVH also has considerable exposure to Vietnam and their supply chains. A tariff-driven cost increase puts them at risk of margin pressure, or it forces them to consider price hikes at a time when U.S. demand for apparel is, well, a bit uncertain, maybe mixed. The tricky part is often the negotiation with retail partners. If PVH tries to pass on the full cost, retailers might demand more support, like funding for promotions. If PVH agrees to that, they end up taking the margin hit anyway. It's a tight spot. So if you step back and look at the whole picture, the line between the potential winners and losers here seems pretty clear, doesn't it? It's not just about how big the company is. It really boils down to strategic decisions, often made quite a while ago, about diversifying supply chains or using nearshoring, versus concentrating production heavily in one region that's now exposed to tariffs. Those who built in flexibility seem poised to get an unexpected benefit, while those who focus primarily on cost concentration in Vietnam might be facing the consequences now.
Yeah, it really underscores the importance of managing supply chain risk globally. It definitely leaves us with something to think about. A final question for you, our listener, to consider. Thinking beyond apparel and footwear, which other companies, maybe in areas like consumer electronics components or perhaps furniture manufacturing, might be quietly reevaluating their own Asian manufacturing strategies right now, seeing the clear financial impact on some of these big names we've discussed. Please remember that this discussion is for informational purposes only. It is not intended as financial advice or a recommendation to buy or sell any security. This analysis is purely the opinion of the authors based on the provided material. Thank you for joining us for Breaking News to Trading Moves.